Welcome, everyone. Thanks for joining us for what we are calling today's session a work in progress. We are all a work in progress. Ironically, we're all a WIP, and ironically, we work heavily with the WIP, which is a work in progress on our actual projects for our financials. As we always do, we're going to start off with our core values. There are 4 core values. Again, the respect piece, we talk about this often and just can't stress how important this is. I see it so often amongst our team, and it is really helping us shape who we are, how we work with our customers, how we work with our vendors and suppliers. We got really good feedback today from Mike about one of our vendors, Herc Rentals. They're doing so many things to go out of the way for us just because of the years of respect that they have built with George and Mike and Jamie over time. So now SCG gets to take advantage of all that respect that's been given over all those years. Being reliable is about not just telling people, giving them an answer just that's best for us, but being able to fix their problem. That's what we do. We fix problems. And so the only way we're ever going to become known as a reliable company is we find solutions. So when the answer is just we can't do it, that can't be the answer. There's got to be other options. Give them options. We do this a lot with our children. We know there's something they don't want to do, so we give them options. Something much worse than that, or that thing. So at least you're giving them options and allowing them to decide at that point what is the best for their situation. Being responsive is just simply getting back to people, and it happens. In this day and age, there's emails and text and voicemails and LinkedIn and Teams chats, handwritten letters. There's all different ways that we are communicating with people. So making sure you're staying on top of all those. And every given day, just going through all your different forms to make sure you're not missing something is really important, just being responsive. And then finally, resourceful. How can we solve our tough problems? We talked about this. We just had a meeting with AUS team and Mike and George and going over all the things that are coming their way. And we're going to face a 2024 that I think is going to be much different than 2023. 2023 was about survival and strengthening our foundation. 2024 is going to be about growth. And we're in a business that is built on service. We are only going to be able to grow as fast as we can provide technicians that can do the work. That's going to be the major holdback. I was just telling about a friend of mine. There's been a job in Tampa. It's a brand new hospital, 650,000 square foot hospital, $55 million electrical bid. And they have 0 companies bidding against them. You know why they have 0 people bidding against them? Nobody can find enough people to do a $55 million job. They have the people. So that's what makes them unique, just the fact that they have people. And so that's the thing we can't forget. And so we're getting a lot of website applicants. We're getting a lot of Indeed applicants. It's going to be the #1 challenge next year. And Jimmy said it earlier, we're going to make bad hires. That happens. That's okay. We're going to take chances on people. Some people, they're going to give us resumes. And if you just judge them by the resume, you're going to say, no way. But if you give them a chance, you meet with them, you never know who's going to be that next superstar for us. We're going to have to take chances on people. We're going to have to take chances. That's the only way we're going to be able to grow this company. Annette, were you going to add something else to that?
I liked your idea about giving people a chance because a resume only says so much, and it all depends on a person's determination and their will to get things done and be a part of the team. And you can't tell that in a 30-minute interview. So it's great to bring someone in and give them a chance.
And we're going to do that a lot. We're going to have to do that a lot next year. That's how we got to the 95 technicians we have now, is just giving people chances. And if you go back and look at the number of technicians that have come and gone over the last 4 years, it's a large list, unfortunately. But that's just the process. That's what we're in. That's the business we're in. We're in the people business. And the world's changing and finding good, hard workers. What I really, truly believe is if we create an environment where they want to be, if they enjoy working with us, you can bring the best out of somebody. People that were failed at other companies, maybe they weren't treated right. And they went in with that mindset that every company treats their team members bad. But if they come work for us and we treat them differently, we can turn them into a great team member who then one day, who knows what they could be doing for us.
I have 2 folders on my desk, all my hires, their applications, but I put in the folders. I have a didn't hire folder and a hired folder. The didn't hire folder is probably 6 inches tall. Like, it's a very big folder. And then the hired folder, I mean, it's still a big folder, but it's half the size of that. And I just keep them in there. And I was going to toss them in the I'm like, nah, I like the visual representation of how many people I've talked to over the years. And I had a vision years ago where, and we haven't got there yet, maybe we will, but every single person that applies gets invited to an interview, show up or not, but every single person that applies gets invited to an interview. So we talk to literally everybody. It takes a lot of manpower to do that. I mean, your whole job is just interviewing people. But I mean, when they show up, we see them show up a lot. But that's still something I want to get to one day where every single person that applies, we reach out to and we invite to an.
Yes.
On that note, I had an electrician that applied there. He was like, what am I applying for? I said, we hire people. We're not hiring positions. We will figure it out and figure out where you're gonna be best suited. And then we've had 2 people that we've let go this year that I've kept in contact with. My side of the street clean, and they're both very remorseful and understand the error in their ways because they know that this is unique and this is not easy to find. So
I can go back to my time early on at STG Com with Jimmy and sitting through some of those interviews. And I can tell you, they've evolved. And when we first started interviewing people, there was a belief I was told people don't want to work in this industry. That's what they kept pounding in my head. And I remember this is 2019 and they were saying that people just don't want to work in this industry. So if you get somebody that's willing to climb a tower, take them. And I remember sitting in interviews and thinking we had to like change the bar. It wasn't like how many people have you killed or how recently was that. So we had to start changing our threshold. Well, now we've kind of built the resume and the type of company that we don't need to accept everybody that walks through the door, but we're going to meet with everybody that walks through the door because you never know that person that's really ready to make that big change in their life. This is our new layout. It's an organizational chart to kind of represent how we function as a company. And it is not to scale and that all humans are the same size, but it is to scale in the number of people. So that is the number of technicians we have working for us. That's the size of our support team. And we are all working together under the umbrella. We're actually restructuring in January to actually produce a tax return that looks just like this. It will be one company, one holding company, all under one roof. We are marketing all of our different services differently. So that's why you have the different names, because how we reach out to customers is going to matter. But what we do internally, it's going to come from everybody. And that's great. That is a really great thing. As I heard how it was discussed at the core meeting last week for electric, is that we're all in this together. And that the fact is that the individuals working for us have the opportunity to go in a lot of different ways. So if things slow down on the electric side and they want to go learn how to do excavation work or they want to learn how to climb a tower, we're going to have that ability for them to do. And that's a wonderful thing for everybody, and including the office. If work changes or evolves, or all of a sudden we're into power generation or we're slipping into becoming an EV dominant company, somebody will have the opportunity to move into that realm if they so desire. What a wonderful thing to know when you're working for a company that you are not stuck in a bucket. Okay, our purpose is building to improve lives. We'll continue to focus on that. It was a great conversation about resumes. When we can bring in that person that wants to change and help them change, what a great experience for all of us. And there's a lot of people that work for us now that can say that. Our objectives, we talked about creating the opportunities. We can't control everything. We can't control the weather. We can't control the economy and the government. But the one thing we can control is the experience that our customers have. How we talk to them, no matter how they talk to us, we control that. And the very first time they talk to you may not be pleasant, but if you continue to treat them well, treat them with kindness all the time, you're going to give them a great experience. And eventually they're going to appreciate that. And they're going to come back and give you a great experience. The niche services, that's how we just be unique. That's how we stand out. We don't want to go do the easy stuff. We want to do the more challenging things. And then we want to work directly for the owner. And then this continuous improvement. We're doing training right now. This is a form of training. And that's great. It's during working hours. But what you do outside of working hours is just as important. Everything you do, that I call it working 5 to 9, working outside of your normal 9 to 5 working hours, is going to be the big difference in your life. If you think you're going to get ahead by doing what everyone else is doing, and that is working 40 hours a week, it's not going to work. You have to look at your outside life and say, are the things I'm doing taking me closer to my goals and objectives, or are they detracting? And everything you do is doing one of those two things. It's either going to get you closer or take you back. And at the end of the day, you can add them all up and say, this week I had more positive than negative, so I'm moving forward. But there are going to be times where it's not. And so continuing to look at yourself on the outside, what are you doing to make yourself better? What are you doing to get your goals? We have our goals as a company, and I hope you're part of that. But what are you doing for yourself? What do you want to do in your own life? Our vision for 2033 is the $100 million in revenue. And while 2023 is not moving us in the right direction, it is building that foundation, building strength, building strong relationships, building new relationships. So we're, in essence, we are getting closer to the $100 million in revenue just through those different methods. 500 team members, we currently have about 150, and then 5 unique services in geographic locations, and we currently have 3. Our 2023 mission was to just remain profitable. Tough year, and yet remain profitable. We are going to be able to do that. We really believe it's going to finish strong and then strengthen the foundation by adding and removing the right people. Okay, let's dive in. What are the main objectives for a project manager? What are the 4 major objectives for a project manager? Profitability, yes, got to be profitable, right? No one else in the company has their initials attached to the job other than project manager. So a project manager's responsibility is profitability. We can actually score it. We can actually say this project manager generated this much profit. So you are responsible for profit. What else? Safety, number 1. Safety leadership. Do not discount the impact you have on the safety of your job sites. When you walk out there and you're not wearing your hard hat or safety glasses or high vis vest, they're going to observe that. When you walk out there and see someone not doing those things that are safe and you don't mention it, they know they're going to realize that. You as a project manager lead our safety. Eventually, we're going to have a full-time safety department or safety person who's just focused on safety and probably more than one person. But right now, it's a combined effort between Kurt and Mike and many others. Bob Wright, we have a whole bunch of people there, and Jim Bates has been helping. But it's everyone's responsibility for safety. Our safety person is really trying to help us, teach us, train us, keep us in compliance. But everyone's responsible for safety. Okay, so we got safety, we got profitability, sales, we got to get work. So we say project manager, and we're fortunate enough to have estimators also, but we have to get work. That comes before any of those other things matter. If you have no work, safety is going to be pretty easy. So we have to get work, we have to be profitable, and we have to be safe. And of course, finally, the thing that keeps us flowing and busy. Cash flow. Yeah, thank you. We all know that one. Safety, sales, profit, cash. Get work, manage work, get paid. These are our objectives. How we accomplish that? We accomplish that by supporting our field with time. We all know that time stands for what?
Tools, information, material, and equipment.
Angelique, nice job. Tools, information, and equipment. So we not only give them our time, but we give them time. We give them the tools, information, material, and equipment. I truly believe people want to do well. People want to work. They want to be successful in their job. They have this inner conscience that says, I am here for a reason. I want to do good things. But when we don't give them the things they need to do their job, what do you think happens? The morale goes down because they think, well, they don't care. Why should I care? So when we show them we care by simply just giving them the things they need to do their job, they're going to do a good job. I really believe that. I talked about continuous learning and improving. We're all responsible for that. It goes beyond these walls. The biggest thing that changed my life was starting to read books. And I was a self-proclaimed non-reader. And when I stopped saying that and became a reader, it changed my life. So what are we doing outside of work, whether it's at community events or your church or you're spending time with your family, your children? It doesn't always have to be work related. It's just, how are you becoming a better individual, better person, aligning with our values? And then, of course, building strong relationships. At the end of the day, your ability to get along with people is going to be your number 1 key to success. They did a study years ago, and they found that the wealthiest people in the world, ironically, did not have the highest IQ. So what does that mean? It's not the smartest people that are highly successful. It's people that get along with people, that know how to work with people, that know how to utilize people, know what people want, and are able to find a way to help them get it. That is going to be your number 1 key to success. And I can't say that enough. If you go back and look through all of our individual team members that we've had to let go, 9 times out of 10, it's going to have something to do with their inability to get along with people. All right, understanding the WIP. We started digging in last week. We got through some of the headers. I want to go through the rest of those, and we're going to do a little WIP exercise together. Earned margin for the prior month is kind of where we stopped, I believe. Is that where we stopped last time? Let's take a look, kick back a little bit. Nope, it is not. We did not. Yeah, we did not get there. Okay. Let me back a little bit. Revised budget, actual costs remain to complete. We know that. Our original gross margin. So let's look at cost to complete. What would be the formula for cost to complete? So cost to complete is revised budget versus minus the actual cost you have spent to date. Our revised budget is different than our original budget. How? When you originally bid the job, you have a budget. As the job progresses, you learn new things and your budget will change. Your budget's going to change, hopefully for the better, but sometimes for the worse. Or you have change orders. And now you know there will be additional cost to that job. So we're going to continue to revise our budget. Our original gross margin is simply what?
Original contract minus original costs.
Yes, original contract versus minus original budget or original cost projections. So that's our original gross margin, and and then from that we can do an original gross margin percentage. What's the original gross margin percentage? How do you get that number?
Original gross margin divided by original contract.
Thank you, Annette. So original gross margin dollars divided by the original contract. That's our original gross margin percentage. And then we looked at our estimated gross margin. Now that's our new gross margin. So we now call it our estimated gross margin. That's what we expect to make now. So that takes our new budget our new contract value and says, here's the amount of money we now think we're going to make, which creates a new estimated gross margin percentage. Does anybody know what a gain fade analysis is? So gain fade analysis says, and here's what's interesting. Sometimes banks and accounting firms, especially for more volatile construction companies, they want to see this. What a gain fade analysis says is, here's how we thought we were going to do when we first got a job. And at the end of our jobs, here's how we actually did. And what they're looking for is they want to know, are the jobs better once you get them, or do they get worse? Are they gaining margin or are they losing margin? And it helps them understand the credibility of the contractor in two different ways. One, are they good at managing the projects? So their projects tend to gain profit, but not gain too much, because they look at them as sandbaggers. They're saying, okay, well, they're going in low, but they really know they're going to make 20%. They're putting it in at 10. They want to know, can we trust this contractor? In other words, what they really think they're going to make is what they're putting it in at. And that's how it's real close to that, plus or minus a little bit on either side. That's a gain fade analysis. It's very important. Also, when you get larger companies, they can do it by project manager. They can do it by estimator. They can do it by foreman. They can do it by customer. They can look and see all the different ways that all those different factors play into it. And who are the people that are making more money in their jobs? Who are the people that lose money once they start running the project? That's why we have the original still on there. And then we have the new on there. So we can see the gain and the fade on those projects. What's our estimated percent complete? Everyone should know this. You have to know this.
Actual cost divided by projected cost.
Okay, you have to know that. Everyone has to know that. If you're a project manager, you have to know that our estimated percent complete is based on our actual cost over our budgeted cost. And that's because your budgeted costs are everything for a project manager. Your budget costs say, here's what we think it's going to take to do this job. Everything you do is aiming for that number. The gap between the contract and that budget is your profit. We're not touching the profit. We need the profit. The profit pays for all of us sitting here today. We're literally eating up profit as we sit here. It's just SG&A overhead. That's what we use the profit to pay. So we need the profit to fund or function as a company. So you're focusing on the budget. You've got to look at that budget. You got to stay focused on the budget. You got to pay attention to it and beat that budget. Okay, so what's next? We have a couple hidden columns. Let's unhide them. See what the mystery says. What this allows us to do, and you guys all have this on your WIP, is it gives you a chance to see where everything was the month before. What was our previous contract? What was our previous budget? What was our previous actual cost, previous percent? So we have them hidden, but if you were ever curious to see activity, and we might actually add a new column, we can actually add a column now to say, show me the months that were active. So if I took a previous contract value versus the new contract value, I can see who made changes to their contract in the previous month. I can also look and see margin. What were the margins projected last month? So if you go as a project manager, you go in there and say, oh boy, we're not gonna do as good as we can. I'm gonna squeeze in there and change my budget. But we can go and look and see, oh, somebody reduced their budget or increased their budget, whatever that may be.
Can't you see that on the change orders? That's all we're doing it in foundation.
As long as you do it through change orders, yes, we'll see.
Okay.
Yeah, we had some
On the-
early on issues where we didn't know that. We would go in and actually change the front end budget, which is a complete mess. Do not ever change the front end budget. This allows us to look at everything and see which jobs have activity. So we can see where we were last month, we can see where we were this month, and if there's a gap, we can call it out. So our estimated margin prior month and our total earned margin, which now allows us to look at our earned margin for the current month. How do we get total earned margin? By the way, I love the word earned. Earned is something that you don't hear very often. We talk about our projects day to day, but what does earned mean?
Did something.
You did something to get that. And so this is what the WIP establishes. The WIP, and we asked this question last week, the WIP allows us to earn revenue and profit before we are what? Complete, invoiced and paid, right? So that's what the WIP does. It allows us to earn these things before we really earned them. We have no proof that we're going to actually make this money, but guess what? We're allowed to say we earn that money. We use the accrual-based accounting that says you have earned so much money. So our total earned so far, what is our total margin? It is, you've got your total expected gross margin.
Is it percent complete of the projected gross margin?
Exactly. So the total earned margin is basically saying the same thing we were trying to figure out how far along are we. We take our percent complete, actual cost over projected cost, and we multiply by what we think we're going to make on the job. So if we're 50% of the way done and we think we're going to make $20,000, we get to earn how much? $10,000. We get to earn half of the total projected gross margin. That's our total earned margin. What we did here for, and then a lot of WIPs won't have this, but it says, well, where were you last month? Earned margin prior month. Where are you this month? Or where are you total? And that says, that's where you are this month. And if we get this down to a science, you should be able to go to the very bottom of this sheet and look at that bottom. You could get a real good feel for how the company's going to do in the month. That's the one file I can go to, Jay can go to, Jimmy can go to, and that anybody that's looking at this can go to the bottom and say, based on that number at the bottom, I know if we're going to be profitable or not profitable in this month. It's a very powerful column. You won't see it in a lot of people's WIPs. It's something we developed. All right, something's hiding in there. Let's unhide it. Earned revenue. What is earned revenue? You know what earned margin is. What's earned revenue?
The percent complete times revised contract.
Yes. It's percent complete times the revised contract. Thank you, Grant. Just like earned margin is percent complete times your gross margin, your overall projected gross margin. Earned revenue is saying, well, for 50% complete, we have earned half of our total contract. And half of our total contract is made up of both cost and profit. So earned revenue is percent complete times contract. It also can be called how much you should have billed to date. It just seemed like that was a lot of words, so we just call it earned revenue. But it's really how much should you be billed on your project, which will now establish a baseline, which will now allow us to create what? I'm jumping ahead a little bit. Over under billings, right? Very good, Heather. So we now look at, okay, what did we previously invoiced? What did we invoice total? And then I got another hidden column here. Unhide that. And this is something Jake created. It's actually a tip. We'll get to that for in a second. So total invoiced, it subtracts what you total invoice minus previous invoice to give us what we invoiced this month. So when this guy built this program, and I'm literally verbalizing what I'd like to see on here, he put a formula in there that said for the last 30 days, month end, month beginning, month end, put the value in here for total invoice, and then put the previous invoice for the day before that month started. So he has a formula in there. I don't know how he did it. So the total invoice is through the end of this month. So let's say we're looking at September's, it would be through 9/30. The previous invoice goes to 8/31. So he established this formula that allows us to say, what was it the month before? What is it now in this month? And that means the difference is going to be how much you invoiced in that 9/1 to 9/30 timeframe. Another very unique thing you don't get to see in a lot of WIPs. So you can see, we want to know, well, what they invoiced for this month? How much have we invoiced? We can again go to this before we even get our profit and loss statements. I can go to this column and say, here's how much we invoiced for this month. This thing is so strong, has built with so much data that we almost don't even need the P&Ls. It almost covers. We need them because of the overhead and the SG&A and all the indirect costs. But if you know what that is, because it doesn't change that much, you can get a real good feel for how the company did just on the WIP.
Yeah, the invoice the month, that's how we did it for the month. At the very top of your profit and loss statement, that's the first number you see is what you invoiced. You know, that the completion every month, you know, we chase that number, but that doesn't land on our income statement.
Yeah.
Our income statement has how much we invoice. So that's really the most important number of the month on the income statements.
So Jake put this in there a long time ago to help people, help project managers when they go in there and they're trying to determine, maybe they don't understand all the formulas. Well, we're going to put it in there for you. And this says, if you're getting ready to bill, you should bill at least this month, minimum billing for the current month. And what it does is it takes how much earned revenue you have minus how much you've invoiced and says, you need to bill at least this much. It's used again on the electric side. Then we have the invoiced this month, as I mentioned. All right, what's retainage? Yeah, they're holding this money back to make sure you finish the job. Does it go into our AR officially or not? Are we expecting this money? Yeah, if you look at an accounts receivable report, there'll actually be a column. It'll say 0 to current, 0 to 30, or 30 to 60, 60 to 90, and then retainage. Retainage is standalone because while it is an account receivable, it's really not. And they're not going to give it to you. You're not going to just randomly get paid retainage. Something other action has to take place. There has to be a release of the retainage, a request for the retainage, and then it shows up officially on the AR as money we should be expecting. As of that time, you're not expecting it. They're not going to pay it. So it's important to know the difference there.
Is it like, do you keep the same terms on your retainage? Like if you're net 90 with your customer, or is it due upon receipt?
It's typically falls into the due upon receipt because they've been holding it for the whole job anyway. But most contractors or companies, GCs, they'll fall into the terms and they'll pay when they want to pay. So
Yeah.
Over, under build. Here's our one of the most important columns on the WIP. And why is this so important? We talked about this last week. What could the underbillings really be telling us? What's it whispering in our ear? If something's perennially underbilled over and over and over, you can't seem to get it overbilled. What are some issues on that job? Could be a bad bid. Could be a bad bid in the sense that you're not as far along as you think you are, or you're not doing as good as you think you are. You're not going to make the money that you're showing because you can't seem to overbill for the cost you've already invested. And here's a really bad thing about underbillings. We're a cash flow driven business, and most businesses are, but we need cash flow to function. If you're underbilled, that means you haven't even asked for it yet. You've already spent the money and still haven't even asked for it. What happens when you ask for it? You still got 30, 60, 90 days to wait for it. So the over billing is a real good indicator for our accounting team, for leadership to say, how is cash going to look in the next 2 to 3 months? Because if we are underbilled collectively as a company, we're in big trouble. That means in the future, we don't have money flowing in as fast as it's going out. And as you know, money never stops. It never stops coming in, never stops going out. What you really hope, though, is it's coming in faster and stronger than it's going out. What's the other thing underbilling could be saying?
Be doing work out of scope, not capturing change orders.
Yeah, you could be doing work and not getting the change order approved, or you're not capturing the change order. So it might not be a bad bid. It just might be changes to work that we didn't recognize. Give me another one. Someone on the electric side, what else could could happen in a situation where we can't get or caught up on our billings?
Didn't build a proper schedule of values.
Yeah, you didn't build a good schedule of values. The schedule of values lays out how we're going to build a job. And sometimes this happens on COM. They say you can build 25, 50, and 25. Well, that might not be enough. That first 25 might not cover us long enough. The 50 might not cover us long enough. That's the schedule of values on the most basic form. But in electric, they might have 30, 40 line items on the schedule of values. If you stuff too much cash down in the bottom and don't have access to it, you could be underbilled for a long time. What's another one that you might run into, Mickey?
I know I got in trouble once back in the day when the schedule changed. I think I had it pretty loaded. The building was going to start on floor 1 and then 2, 3, 4. So that's how I had it loaded. So the schedule change forced us to go backwards, meaning my loaded end was on the back end.
That hurt.
Yeah.
Yeah, I've had that same thing happen to me too. It was a 2-phase project. We put all the money in phase 1, then they decided to switch the phases. So smart, yeah, felt intentional. Well, one of the other things that could happen is improper forecasting. So if you're turning an invoice in on the 20th of the month and you're supposed to be covering yourself through the 31st, you got to remember, you can't just go off your current cost a day. You got to think about 2 more weeks of labor, all the materials going to hit that job, all those other things, and you got to build that into your schedule value. So improper forecasting, not looking ahead. Really important column. This should be something that you're looking at as one of the first targets. First things first, can't be over 100% complete. Next thing, we should go look at our over under billings. Remaining invoice, that seems like a pretty simple one. What's that one?
Contract minus bill to date.
Yeah, revised contract minus bill to date remaining invoice. Pretty simple. Why do we have this on here though? So that just in case someone has a negative remaining invoice, what does that mean? You overbilled. You billed more than the contract. That's what the negative invoice number means. And that can't be. That means either one of 2 things. 1, we made an error in the billing, or 2, we haven't got a change order in the system to increase our contract. So one of the first things that will go to, she'll look on the WIP, she'll sort by this. There's a couple of flags up there. One of them is you cannot have a negative remaining invoice, and you can't be over 100% complete. So we're going to target those right out of the gate.
A lot of times for us, it's waiting on change orders.
Yeah.
So, the whole job's billed, we have $2,500 change order for a troubleshoot that we're chasing up.
Yeah, as long as you don't invoice for it before you get the PO, that's okay.
Yeah, or it's just gonna get keyed in to foundations, but you know, somehow accounting invoice for it, but you didn't change it somewhere.
Well, I mean, under remaining the invoice, that's one of the things that we watch.
Original projections are revised projections. So that's pretty obvious where we were initially, where we are now, and then what's actually happening. And this will tell us our percent complete. In this case here, we went over above and beyond. We're 2,948,000, 75% complete. We want more than 110%. We want 249,000%. That was just an error because we didn't have a budget. So don't worry about that one. And then we do the same thing for labor. We do the original projections, revised projections. And here's a really important column to look at. And that is our labor hours. So you look at the job, original projection 32,000, we increased to 34 and actually took 42. Now you look at that day, that job couldn't have gone well, but what ended up happening was our revised projection said it's gonna cost us $32 an hour average to do the job. Well, we did it with a bunch of younger apprentices and we did it for 26. So guess what? We saved $6 an hour, well, $5.50 an hour, 60 cents on the labor. So even though we went over on hours, we made it up on the labor rate. Took us longer because you're using less skilled help, but because their cost was less, we ended up being okay. And there's our 83% variance of that. But backlogged earnings, what is backlogged earnings? Very important one. How do you get backlogged earnings?
Estimated gross margin.
Yep.
That's what you're starting with, your contract.
Yep.
And it's minus your,
Earned margins rate.
Yes, good teamwork, good teamwork. The total estimated gross margin minus your earned margin today is your backlog earnings. Now, there's a lot of other ways to get there and Kurt described one of them, and there's many more, but that's the simplest one. I already know those two numbers. They're columns on there. All I gotta do is subtract the two. How much do I think I'm gonna make? How much have I made? That's what's left. And we go to the bottom of this and let's say we know it takes 200,000 a month to run our company. And I mean, run like SG&A and overhead. And we got 1.4 million in backlog earnings. What's our runway? We have 7 months at 200,000 a month of runway. That's something we pay attention to. Obviously, it's in a perfect world and all the jobs aren't going to finish in 7 months and we're not going to make it evenly, but it's a good number to know. We have $200,000 a month. We got 1.4 million backlog earnings. Good to know. What's the outstanding AR?
Thing that's been invoiced that hasn't been collected.
Yeah, so everything that's been invoiced that has not been collected, that's outstanding AR. And outstanding, not in a good way, like, oh, you guys did outstanding job. This means outstanding, like it's still sitting out there. So outstanding AR means they haven't paid us yet. And if you go to the bottom of that one, that's going to give you a real good idea of how much is owed to us. Not even counting what's not even included this. Retainage. You know, we haven't included retainage. And then we have this column called MATLAB. And so what that does is we were trying to figure out why the material and the labor weren't adding up to the total actual cost. We figured it out and that fixed it for us. Don't need this anymore. And then the final one is actual cost and labor, another one we used to determine if we had an issue. So those two are unnecessary. We were using them to determine something else. Okay. So that's the WIP headings. We went through every single one of them. I hope you learned something from that. And now you will become a WIP master. Let's dive back in. All right, so the reason we have a WIP is because if we didn't, institutions wouldn't touch us. Banks, bonding companies, insurance companies, we would not be able to show profit. If we wanted to show profit without using the WIP method, what would you say is our profit on this project to date?
Minus $10,000.
One way of saying is minus 10,000. How'd you get that, Mike?
The cost to date and the received date. So it's like the received date minus cost to date.
Yeah. So we took our how much we've spent minus how much we received, and our bank statement says minus $10,000. So that's one way to look at your job. And again, think about how often our jobs are a negative cash flow position, just due to the nature of construction. You start working and 30 days later, you send an invoice and 60 days later, you get paid. You're going to be in a negative cash flow position all the way through the job. So if we had to show our profit and loss statement as a matter of that, it'd be a huge negative number. What's another way you could look at this? We build 50, we're costs are 40, so we're up 10. So that is another way to do it. What number's missing to allow this to go into the WIP?
Cost to date.
The budget. Yeah, you're missing the budget. So once we establish a budget, then we can get a percent complete. And so in this case here, we know our budget's 80,000. What is our percent complete?
50%.
50%, which we know now that our earned revenue is what? 50,000. We've earned 50,000. We've earned 50% of the contract value of 50,000, which means our earnings, our earned margin to date is what?
10,000.
It's 10,000. Yeah, it's half of our projected gross margin. What's our projected gross margin?
20,000.
20,000. We get half of that, 10,000, because we're halfway done. So that's what the WIP does. The WIP allows us to establish a true value. And even though Brandon pointed out, yeah, you could call it 10 just based on billings and costs and it happened to work out that way, but it won't always work out that way, trust me. So we have to use this WIP method, which basically says, okay, we're going to go off a budget, projected costs. Got to remember your budget. You got to know your budget. Here's the WIP exercise. Start filling in the answers and just go to 1, 2, and 3. Just stop at 1, 2, and 3. And then we're going to go over them real quick. You're going to probably need a calculator unless you're really good at math in your head. 1, 2, and 3 only. Okay. Percent complete. Everyone has to have this right. What is our percent complete?
67.
67%.
Yeah. 66.7%. And that goes on and on and on, but 66.7%. How did you get it, Heather?
I took the actual cost to date divided by my projected costs.
So again, the thing we have to know when we're running projects is actual
Yeah.
cost over revised projected cost. That's our percent complete every single time. Actual cost to date over revised projected cost, that is our percent complete. And we have to know that because everything else we do in the WIP is going to be based off of those two numbers. The relationship between those two numbers determines our next number, which is how much we should be billed. What's our proper billing amount if we're 66.7% complete?
244 and change.
Yeah, so it's
I did 244, 550.
243, 763.5.
and a quarter. Thank you. Yes, it's 243, 763 and a quarter. That's our proper billing amount. Because if you do it mathematically, you would take those two numbers, come up with a number, and then immediately multiply by your contract. There's no, replugging in 64.67. So 243, 763 is a proper billing amount, because what it says is, and what's another way of calling that? What did we learn today? What would we call our proper billing amount? Earned revenue. And that means that we are over or under billed, and by how much?
We're underbilled by 46,763.25.
$46,763.25. Underbilled. Okay? We're gonna pause there for today. We're gonna pick it back up at number 4 and on next time. So if you didn't get that, just remember, everything comes around this. Because if you don't get this one right, you're probably not gonna get the rest of them right. Okay? And then when we're done with this, we're gonna give it to you and you can build this in Excel and have fun with it. That was one of the things I did. I loved rebuilding the WIP and understanding how it worked. And so that's how I learned it. And I can tell you right now, I mean this in all jokes aside, I did not understand WIP. I didn't understand financials. I didn't understand how projects worked. But when I had a general manager who forced us to understand this, he would sit down with us and go over the WIPs. And the first column he went to was the over under billings. And then he would work backwards. And what I learned is that I had to understand once I figured it out, once I understood how the WIP worked and how financials for a project worked, completely changed how I was as a project manager. Because now all of a sudden I understood the value of change orders and the value of profit and the value of invoicing and building that schedule of values. Everything clicked for me by understanding this WIP. So you're never going to become an accountant. We're not asking you to be an accountant. What we really want you to do is understand the relationship of the numbers that drive our financials. We want you to understand the relationship of the numbers that drive our financials. And when you understand that, your margins are going to go up, your cash flow is going to go up, your value to the company goes up, everything increases.